My name is Ricardo Reis, and I am the director of the Center for Macroeconomics at the London School of Economics, which is one of the co-hosts of this year's annual CEBRA meeting. And in that capacity, it's my distinct pleasure to be speaking to you here to introduce Ben Broadbent, who's going to be our keynote speaker for today in the conference. Ben has been the Deputy Governor at the Bank of England in charge of monetary policy since 2014. And in that capacity, he is a member of three key committees: the Monetary Policy Committee, the Financial Policy Committee, and the Prudential Regulation Committee. His career at the bank started as a member of the MPC in 2011. And before this, he had spent before this decade as a public servant, he had spent another decade working in the private sector, namely at Goldman Sachs, as an economist that followed macro policy and developments. Before that, another decade in academia at Columbia University and Harvard University. As a result of these 3 decades of experience, starting from academia to the private sector and as a public servant now, Ben is really an ideal speaker today at this annual meeting. This association brings together economists in academia, the private sector, and especially in policy institutions who are using research to make sense of the challenges that face central banks and macroeconomic policymakers. And Ben has, throughout his career, from all these 3 perspectives, made really fundamental contributions to our understanding of how that works. So with that in mind, I'll pass the floor to Ben Broadbent, who will be our speaker for today. Thank you, Ben.
Thank you very much, Ricardo. And I must apologize because it is entirely my fault for the late start we had today. I may indeed be old enough to have had 3 decades in the workplace, but they haven't been enough to teach me enough about IT to figure out how to share my presentation. So Ricardo's sort of acting as my agent in this respect, and I'll have to ask him to change the slides when necessary. And indeed, Ricardo, you might go to the very first one, which just has a summary of what I'm going to say today. I want to begin by thanking everyone for asking me, and for those that have dialed in listening. This is an extremely important time for central banks, an innovative one indeed, and it's vital that we learn from not just our research, but others on the big questions. For our part, the Bank of England launched its new agenda for research yesterday, and I'm sure Andy will tell you something about that in the panel following this talk. My topic today certainly isn't a new one. In fact, it's almost as old as economics itself. I want to talk about monetary finance, so-called, what it is, perhaps more importantly, what it is not, what it might be worth, and when it's been used in the past. I say it's old, but the topic has, of course, been aired quite a lot recently. In the face of the global pandemic, governments have taken very significant fiscal actions to maintain incomes and to preserve economic capacity. And at the same time, central banks have aggressively eased monetary policy. And because these things have occurred alongside each other, some commentators have suggested that central banks are engaged in, quote, monetary finance of government's deficits. However, one of the points I'll want to make today is that the coincidence in time of these things doesn't really tell you anything about monetary finance. That's because both the monetary stance and the fiscal balance are naturally cyclical. And indeed, the monetary stance is particularly so when the central bank is targeting inflation. So economics slowdowns push up the government deficit, and because they'd otherwise depress inflation, they also tend to result in easier monetary policy. Indeed, depending on how persistent the downturn is expected to be, and in the presence of open capital markets on how widespread it's expected to be, you'd also expect to see lower long-term bond yields, even as the government is obliged to sell more debt, and even without any extension of QE. There is nothing, therefore, intrinsic in the nature of these transactions or in the co-movement of these various things that constitutes monetary finance. Instead, what really lies behind that term is an institutional question, or a pair of them maybe. who is doing what and why? Is monetary policy controlled by an independent authority using its tools solely in pursuit of a fixed nominal objective, or is there instead some sort of fiscal dominance over the central bank, which is then forced to subordinate its own objectives to those of the fiscal authority? In other words, it's a matter of ends, not of means. And ultimately, therefore, the better way to identify this thing is via the behavior of the objectives of policy, not the instruments. If inflation were to rise materially above its target, and if it tends to do so, in particular when the public finances are under strain, that may be evidence of fiscal dominance. If, on the other hand, easier monetary policy is necessary simply to stabilize inflation, it's hard to see how it can qualify as monetary finance, no matter how the fiscal balance is behaving or what is the prevailing level of government debt. Now, that is not to say, of course, that the fiscal position is wholly irrelevant, because higher inflation can help, if only to a degree and at a wider economic cost, in easing fiscal constraints, particularly if the public sector's liabilities have a long maturity. So very high levels of debt could therefore test these institutional arrangements, and we're all familiar with some of the very dramatic inflations in history, most famously the German inflation of the 1920s, but there are plenty of others, and these are very often fiscal events. So Ricardo, if you just flip forward one page, I've taken this, let me go back, but I've taken this from the Reinhard Rogoff book, Following the Financial Crisis. I quite like it, and demonstrates that at least through the 20th century, when you had a rising share of countries going through formal defaults on their debt, you also saw a rising share of countries with very high inflations. And those high inflations are very often fiscal events. But I do want to make a couple of important points in this respect. One is fairly technical, at least to people who aren't steeped in central banking, but it still matters, and that is that QE, somewhat ironically, has made it harder to inflate away public sector debt. Obviously, one could make far bigger and broader points about the cost of inflation, and I won't go into those, but for what it's worth, asset purchases, when they're paid for with central bank reserves on which short-term interest is paid, and that's very important, reduce the fiscal returns to higher inflation, because they have the effect of reducing the average maturity of the state's interest-bearing liabilities. And together with index debt issuance, in this country at least, it means that the share of non-indexed longer-term government securities in the hands of the private sector, which is essentially the tax base on which surprise inflations can work, is significantly lower than it was, say, in the 1970s, when Britain had extremely rapid inflation. And I'll illustrate that point later on with a very simple stylized simulation. The second point, and perhaps you could flip to the next slide, Ricardo, is that even if it's true that very rapid inflations are very often fiscal events, and even if one can find some episodes in British history in which that's the case, in which fiscal pressure led to monetary looseness, there is no empirical correlation in the time series, in the long time series in this country, between levels of government debt and inflation. I want to make the point, the obvious point in some way, that what matters much more is the prevailing, indeed sometimes perhaps just the expected monetary regime. So you can see in that huge inflation in the 70s that actually public sector debt was pretty low by historical standard. On the other hand, when you look at the very high levels of public sector debt, and I'm going to pick out a couple today, the Napoleonic Wars, the early 19th century, and then again the huge surge in the First World War. Inflation, particularly in the first of those episodes, did not go up by much. It's true that the gold standard was abandoned at those times, both in the early 1800s and again in the First World War, but it was only abandoned temporarily. And I think even that belief that it was going to come back, and it was a strong belief in the early 19th century, helped to contain both inflation and certainly government bond yields. Anyway, let me turn now to a little more detail, starting with this point about the cyclicality of monetary policy. I've got a couple of graphs on the next slide, which illustrate how cyclical policy is under inflation targeting. These are two versions of the same thing, just changes in monetary policy, basically interest rates, although I've used an independent series for what the authors have called a shadow rate, trying to translate QE into interest rate space. So the left-hand graph in yellow, that's just the change in that from one year to next against GDP growth. They're reasonably well correlated. The right-hand slide is a sort of smoother version of the same with two different measures, the survey measure of growth in black, and then the average vote on the Monetary Policy Committee, extremely tightly correlated. If you go to the next slide, you can see that without, it's not greatly surprising, the government balance is also highly cyclical. Clearly, active fiscal policy can lead these two lines to diverge, and there was a big loosening in the late 90s and early 2000s. But basically, they're pretty well correlated, and it's no surprise, therefore, to find with each authority acting independently of the other that nonetheless government balances and the monetary stance are themselves well correlated. More than that, if you go to the next slide, and I find this quite informative, this slide, it looks as though the tight cyclicality of monetary policy is necessary for stabilizing inflation. That's what our models tell us, and I think it's borne out clearly in the UK history. So on the x-axis here, I've got that correlation between short rates and GDP growth. And as you can see, it's pretty high during the inflation targeting period. And I've got the standard deviation of inflation on the vertical axis. And you can see that under inflation targeting, inflation has been pretty stable, happily. In fact, these numbers, or these estimates at least, of the CPI go back in the UK as far as the early 13th century. I don't know what they're worth, but they do exist. And at least if you take those as given, the last 25 years have had the most stable inflation of any quarter century in that 800-year period. By comparison, you can see how they're ranked across, taken the last, these going back to essentially the start of the classical gold standard in the mid-19th century. And you can see that during that gold standard period, inflation wasn't quite as stable. That wasn't the objective, obviously. It was close to it, but it wasn't precisely the objective. It was nonetheless, a significant cyclicality of short-term interest rates. In the intervening period, both in the post-Second World War period, and particularly period covering both world wars and the interim, there was little correlation between short rates and economic growth, and much higher variability of inflation. So I think it's necessary to have cyclical monetary policy in both directions, i.e. the ability to ease policy in downturns if you want to stabilize inflation. Turning to bond yields, quickly, if you go on to the next slide, Ricardo, and this fact is well known, that the bond yields are much less cyclical. Indeed, those little orange bars, which measure the same correlations across those 4 periods, none of them statistically significantly different from zero. And another thing one can point out about bond yields, if you flip to the next slide, Ricardo, is that, and again, this is well known in UK data, there's no correlation either between bond yields and government debt levels. Now, I don't think we should be terribly surprised by either of these things. Bonds are long-term instruments, so what matters more for their yield is expected growth rather than what's going on right now. And secondly, of course, and particularly these days, we live in a very open economy. The UK is a classic small open economy, and therefore its expected growth, not only is it expected rather than current growth that matters, it's expected growth in the global economy that matters more, not really what's going on in the UK. And that openness also has obviously a bearing on the effect of changes in public sector debt on the cost of that debt. When the UK government borrows money, it's tapping a global market for savings, not just a domestic one. And from the perspective of a relatively small single borrower, certainly one who's judged still to be creditworthy, a greater demand for credit needn't have any impact at all on what is essentially a global price. And you can see, if you just flip to the next slide, that changes in real bond yields across different countries are extremely tightly correlated. Now, this doesn't mean that a country's fiscal position never matters. It's obviously not true, just as for an individual household or company, a government's creditworthiness can affect the risk premium over the global rate that is charged for new borrowing. And if there's a concern that high levels of debt might result in some sort of default, whether that's a formal default or in the form of much higher inflation, you'd expect to see that reflected in some sort of extra margin. But that is a long way from saying that any variation in public sector debt will have a measurable impact on its price. And it's further still from the claim that such an effect should be the dominant, let alone the only, influence on those yields. That's clearly not the case in the data or indeed the theory. So if you read something that seems to suggest that the only reason bond yields are low is because of QE, and that higher government debt would definitely have pushed up those yields without QE, I think you should take those things with a large pinch of salt. More generally, as I say, if you happen to see monetary easing occurring while government debt is rising, and this is the main point I wanted to get across in this bit, one should not conclude from this that there's something amiss. In downturns, the deficit rises, and easing monetary policy is exactly what an independent inflation targeting monetary authority should be doing. As I said earlier, the acid test is alternate behavior of inflation itself. Now, those two things can be linked. As I say, the independent integrity of monetary authority can, in extremis, be affected by the level or the fiscal strain on the government, precisely because inflation can, in principle at least, reduce that strain. And I want to just go through some extremely simple stylized simulations to gauge the effect of that, using numbers that roughly correspond to those in the UK. As a precursor, I should point out first that if extra inflation is anticipated, it'll have very little impact on the public finances because because there's very little in the way of non-interest bearing government liabilities, and B, because obviously investing institutions care about real returns, and they did expect inflation to come along and they could take account of it in the price they're prepared to pay for the debt. So, as I say, if extra inflation is fully anticipated, there really wouldn't be any impact on the public finances. Obviously, when you've got long-term debt around, saying inflation should be fully anticipated is quite a tall order. because that debt lasts for years and years, and it would require investors to know a long, long time in advance that it's coming, if indeed it does. In the UK, for example, 40% of the government's existing debt was sold more than a decade ago, and the average maturity is more than that. So there would seem to be quite a bit of scope to spring surprise inflations if indeed the government was free to do so, or wanted to do so, and reduce the real value of that existing debt. And I'm just going to go through these little experiments now. If you go to the next slide, in which I've simulated what is a surprise increase in inflation at the time it occurs. So there's a sudden announcement that inflation is going to go up here, respectively, by 1 and 3 percentage points. So imagine the target is suddenly changed from 2 to 3 or indeed 5. But the people know thereafter that it's going to stay there. So I'm assuming here, very simply, by the way, that all the real influences on debt, namely GDP growth, the ex-ante real interest rate, and indeed the primary deficit relative to GDP are all unchanged. And you get this sudden lurch up in the rate of inflation, a permanent increase, which, because the ex-ante real rate is unchanged, produces a similar, identical rise in the whole yield curve, the whole nominal yield curve. Now, I've assumed in here, and this is, I don't think, out of line with what we're currently seeing, that the growth rate of the economy is higher than that real interest rate. And that ensures that without having to change the deficit, or indeed, that there is a stable, steady state for debt. So the effect of this is going to be temporary. And indeed, I don't think the numbers even here are that big, even with quite long-term debt. The government, that debt matures over time, and the government's having to refinance it at higher interest rates. They're not negligible numbers. If you raise the inflation rate by 1 percentage point, after around 15 years, you can reduce. By the way, I should point out as well, I've assumed in line with the UK structure that around 1/4 of the debt is indexed and so unaffected by inflation. But even then, you get a drop of around just under 5% in the debt ratio if inflation is permanently a percentage point higher. You get slightly less than 3 times that for a 3 percentage point increase because the existing debt rolls over more quickly relative to nominal GDP. So that number is something like 12 for the peak effect, and then it gradually dies away because of G being bigger than R. However, and this is the point I really wanted to get to with QE, even these numbers overstate. Actually, let me first, before I do that, just point out what that surprise inflation has done in the UK in the past. As I say, a 1 percentage point change doesn't give you that much benefit in a world in which all the debt is held by the private sector. Clearly, if you have very rapid inflations, very rapid surprise inflations, you can do a little more than that. I just wanted to quickly show you what happened in the 1970s. If you flip to the next slide, Ricardo, you can see what sort of gains, if you want to call them that, severe losses for bondholders are possible. In 1970, the yield on a newly issued 10-year gilt was around 8.5%. It's hard to say what investors expected for inflation, but if they'd expected something like the average of the previous 5 years, it would only have been 4. That's a pretty healthy real return, one that for an investor holding the bond all the way till maturity would have given them a cumulative real return of over 50. What we actually saw, because inflation averaged 13% a year during that decade, was a cumulative loss of 35% on this so-called safe asset, and an average return of around -5% a year, therefore. Furthermore, it seems to me possible that the high ex-post real return in the 80s may partly have reflected a higher inflation risk premium. Following that experience, no doubt people came to expect higher inflation, and the fall through the 1980s came as a beneficial surprise for people who bought conventional gilts in, say, 80, 81. They got a huge ex-post return of 10% a year, but I think it seems to me quite possible that part of that return was simply a compensation for the huge volatility of inflation they'd also come to expect. But let me get back to this point about QE that I wanted to make here. And it's this, that QE, this is not the point of it. The point of it is to stimulate activity and ultimately inflation. But one of the effects of it is that it shortens the public sector's liabilities and reduces, therefore, the fiscal returns, if you can call it that, to higher inflation. So in the UK, around 2/5 of the stock of conventional gilts is now owned by the Bank of England's asset purchase facility. And that APF is financed with short-term reserves that pay interest. So obviously the effects would be very different if we had financed purchases of gilts with stuff that didn't pay interest, which is what I think people understand very often by the term money. And in that sense, I think describing QE as printing money quotes is pretty misleading. It's more accurately seen as a maturity swap, taking out of the hands of the private sector long-term assets and giving them instead short-term but still interest-bearing claims on the state. And what that means is that when you get higher inflation and the whole level of nominal yields goes up, the APF starts to lose money. It's paying out short-term interest rates that are higher, but still receiving these coupons from the gilts it has on the asset side. And that money has to be paid for ultimately by the Treasury. There is an agreement in place that ensures that's the case, that Treasury takes the positive cash flow from QE, and when it's negative, reimburses the asset purchase facility. So if you go on to the next slide, Ricardo, what I've done here is simply to, well, let's take account of that in the overall profile of public sector, real public sector liabilities, or at least their ratio to GDP. The dotted lines give you what I had before, and the solid lines are now with this adjustment for QE, and you can see that the effects are materially smaller. So 1 percentage point permanently on the rate of inflation would have a peak effect on the debt ratio of less than 3%, which in the grand scheme of things is not very large. And as I say, if you've got a rise in the inflation risk premium to boot, that number would be still smaller. And I think this is, as I say, it's not the goal of QE, but I think it does have, it is an important thing to realize. And so overall, since the 1970s, when we had that very rapid inflation, the combination of index gilt issuance and then more recently QE have materially reduced the fiscal returns to higher inflation. Now, whether that very rapid inflation was motivated primarily or at all by fiscal concerns and the desire to inflate away debt is hard to say. There were probably many contributing factors. What we can say, as we saw earlier, is that in the long history of the data, and perhaps I'm going to ask you, Ricardo, to go back to that earlier slide on public sector debt and inflation. I think it was second or maybe third slide. There's the one. There's no link between these things at all. As I say, you can see in 1970 there was, actually pretty low levels of government debt. I think the debt ratio was 60% in 1970, which was the lowest it had been since the eve of the First World War, and yet you had fastest decade of inflation in British history. And similarly, if you go back to really high levels of debt, for example, in the early 19th century, and remember that taxes were also far lower share of GDP at the time, you didn't have as much action, certainly up in the run-up to the wars against France, say in the 50 years up to the French Revolution. Debt was higher than in 1970 every year of that half century, and yet inflation wasn't high, and the gold standard was adhered to rigidly. So people could go into the Bank of England and they could, using their Bank of England banknotes, buy gold at a fixed price. Now then you get to those wars and a couple of things change. First of all, government spending goes up. We're talking about the early 1790s very materially. It kind of triples in the space of 3 or 4 years. And part of that was financed from the Bank of England. And second, at that time, there was a lot of panic buying of gold because people feared French invasion. And indeed, it was it took 1 day after a small French force did actually land on the British coast that the government led by Pitt reacted by suspending the convertibility of notes into gold. Now, if you go on one slide, go back to where we were. I think I've got a slide on the back. Oh, there we are. Just go back up forward one, Ricardo, I think it is. Yeah, that's the balance sheet at the time. That top line, suitably in yellow, is the gold stock at the bank. You can just see it starting to dwindle through the early 1790s and then all but disappearing. 1797, which is when the decision to suspend was taken. And the supply of banknotes in green started to go up a lot. And there's no doubt that this sort of qualifies as monetary finance. This was a huge seismic event in British financial history, vigorously debated. Indeed, it led to some big breakthroughs in our understanding of monetary economics. And of course, in many quarters, vigorously opposed. It was within 2 or 3 weeks of suspension that Sheridan, the great playwright, who was also a Whig MP and not well disposed to the Tory Pitt, therefore mocked him by saying that the Bank of England, indeed mocked the Bank of England, was like an old lady who'd lost her respectability, having been seduced by a young man, i.e. Pitt, from the wrong end of town. And if you go forward one slide, it was shortly after that Gilray painted this famous cartoon. And there's the old lady sitting on her chest of gold being seduced by Pitt. And that's how the nickname Old Lady came to stick. And of course, throughout that early period, more early economists, I should say, many of them blamed what inflation was. Prices rose at about 2% a year during the Napoleonic Wars, squarely on this suspension and on the growth of unbacked banknotes. And we're always calling for an immediate restoration of convertibility. You go forward one slide, you can see what Ricardo thought of the discretion of the Bank of England at the time. This was just after the government decided that it wouldn't restore convertibility until the war had ended in 1811. It decided that. I trust the day is not far distant when we shall look back with astonishment at the delusion to which we have so long been subject in allowing a company of merchants that's the Bank of England, notoriously ignorant of the most obvious principles of political economy to regulate at their will the value of the property of a great portion of the community. I should say, in defense of the modern company, that there aren't any merchants that I come across when I walk its corridors. There are lots and lots of economists. And more importantly, I think, if one takes the value of the property of a great portion of the community to be the CPI, it's not regulated at will, but towards a target, and indeed that target of 2% a year is set by the government, not by the Bank of England. Nevertheless, this was very vigorously debated, and I should say that there was a strong expectation that the monetary regime would indeed be restored. It was just really the argument was about the timing. And in that respect, I think that had a bearing both on inflation itself. This was not a hyperinflationary episode when the bank poured money into the economy and people lost entire confidence and spent it as quickly as they can got it. They're willing to hold it because they knew that in time the gold standard would be restored. If you go on to the next slide, you can see the behavior of prices there on the left-hand side. And essentially, I would describe policy then as accommodative. Bank of England allowed the price level to vary with the swings up and down in government spending, which themselves followed the intensity of the conflict. But overall, up until the end of the war, Waterloo in 1815, prices rose an average 2% a year, and then came back down again, indeed, with the reinstitution of the gold standard, which meant, by the way, that any fiscal benefit to the government from rising prices was obviously then reversed once convertibility was re-established. The second episode I look at in the talk, in the text of the talk, is First World War, which was the next time the gold standard was suspended. Here the numbers are even bigger, huge increases in government spending on goods and services. The share of government consumption in GDP rose by almost 40 points relative to the pre-war period. Essentially, most of the economy was given over to the war effort. The inflation was much faster, but again, possibly it would have been faster still had there not been a degree of belief, at least, that the monetary regime would be re-established. And because of that, if you go forward one slide, I think this is the right one, you can see on the right-hand side here that bond yields, even in the First World War, were well contained. So the couple of points I wanted to make here. One, as I say, that government spending was much more rapid, that's the orange bar on the left-hand side, than it had been in the earlier war, and I think that had something to do with the higher inflation. Obviously, as I say, levels of debt to GDP seem to have no bearing on the relative rates of inflation across these three episodes. The little grey one is the 1970s. And the point about the 1970s is there was no nominal anchor at all. So not only did inflation get out of control, but as we've seen, nominal bond yields reacted and drifted up to very high levels as well. And the highest ever yield on long-term debt the British government has ever had to pay in the 300 years of data we have was in 1974. And indeed, that 10% ex-post real return was also the highest on record through the 1980s. So I think that what's striking about this is even on the occasions when fiscal pressures led to an abandonment of the monetary standard, and because there was some sort of belief, which was stronger in the earlier episode, that monetary standard would be restored, actually the inflations weren't that rapid, and the most rapid inflation over any 10-year period was when public sector debt was quite low, but crucially there was no nominal anchor even to abandon or any belief that there would be one instated anytime soon. So let me wrap up, and in doing so, make a point about the current episode in particular. So the first thing I said was that I think fears that what's going on now in monetary finance are misplaced. And at the very least, one should remember that under inflation targeting, monetary policy is and has to be very cyclical. And easing it in downturns is exactly what an independent inflation targeting monetary authority should be doing, no matter what's happening to the fiscal balance or the level of government debt. That's not to deny the connections between the two, or the many occurrences of fiscal dominance and monetary finance in various countries over the past. But the link between debt and inflation is certainly not a simple one. And in British history, at least, what seems to matter much more is the credibility of the monetary regime. Indeed, even in its absence, the belief in the gold standard was such that inflation, certainly in the earlier episode, was lower than in the 1970s, despite much higher levels of debt. Now, the pandemic, I think, differs from all these episodes in important ways. So unlike the wars, there has been no material increase in government spending on goods and services. And I think this is an important point. Government debt has gone up on this occasion, not because the governments have started buying lots of stuff or employing lots of people, but mainly because they've made transfers to compensate for lockdowns to the private sector. And in fact, overall aggregate demand has fallen. And despite those transfers, spare capacity is rising. We know unemployment is going up. And that is the reason monetary policy is being eased. And unlike the 1970s, of course, there is now a stable monetary regime in place. As it happens, it would be quite a lot harder now, given index debt issuance and somewhat ironically what QE has done to maturities of public sector liabilities. It would be harder to inflate away that debt. But the most crucial thing for price stability is a stable regime governing monetary policy and macroeconomic policy more generally. And for that to be effective, obviously there has to be credibility, and that credibility relies in part on monetary authorities being held to account. So it's crucial that the MPC should have to explain why its actions are necessary for meeting the inflation target and for nothing else during this episode as in any other. And I'll finish with the last slide, because for our part, one important gauge of that credibility is expected inflation in financial markets. And I think that were there serious concern that inflation was going to drift away from the target, whether because of high levels of government debt or for any other reason, you'd expect to see it reflected in higher so-called break-even rates, the spread between the yields on conventional and index bonds. And thus far, at least, that does not happen. They've remained pretty stable through this episode. And I'll end just by saying that come what may, the MPC will continue to respond to economic events as they unfold to ensure that inflation does indeed remain stable. And I'll leave it at that.
Well, great. Thank you very much, Ben, for that very insightful talk. We will now, we have a question. So here it is. Sorry, because with the sharing of the screen, I wasn't looking at my. So we have one question from Juan Castañeda for you to clarify the criteria used for the amount of asset purchases at this time or looking forward, given the stock of debt, that is the extent to which the monetary fiscal coordination will affect asset purchases moving forward or not.
Well, in those simulations, it's very simple. The only thing that matters is the current level of QE, because in the experiment, at least, as soon as the news of higher inflation is announced, all the yields go up. And from that point on, given that nothing unexpected happens, it doesn't make much difference what happens to QE, or I mean, I've held the, as far as the fiscal policy is concerned, I've held constant in those simulations the deficit to GDP ratio. But what matters is the current level of QE, and as I said, around 40% of conventional gilts are now in the APF. And if you think about that tax base I mentioned, you go back to the 1970s, you know, all the longer term debt was conventional debt held by the private sector. Now less than half of it meets that description. A quarter is indexed, and 40% of the remaining three quarters is held by the QE fund. And that's the important point. It means that, you know, the returns to inflation are more than halved relative to that.
Very good. We are just on time because we have so we can take a short 4-minute break to kind of switch people and lock people in and move on to the panel, where the panel is going to be hosted by Andrew Aldane. But before doing that, let me thank Ben for his insightful keynote and for his participation in the conference. And with that, I would pass it to Andy and for the other ones to unmute